Welcome to today's episode of Peak Market Watch. We speak with market leaders in commercial real estate and related services who have a close pulse on the current market environment. My name is Anton Madley, co-founder and CEO of Peak Financing. My co-host today is Ben Suttles, principal with Disrupt Equity. Disrupt Equity actively invests in and manages multifamily properties. Today, we are honored to welcome Carl Whitaker, Director of Research and Analysis with RealPage. Welcome, Chris. It's a pleasure to have you with us today.
All right, Carl. Yeah, we're happy to have you, man. Thanks for stopping by.
Absolutely. Thank y'all for having me.
Yeah. So why don't you give us a brief background about yourself as well as RealPage? Obviously, RealPage, anyone in multifamily has heard of the name, and you're a real powerhouse when it comes to data and services in the multifamily space. But why don't you tell us a little bit more about you as well as RealPage?
Yeah, absolutely. I'll give the quick 30-second elevator pitch, or as much of a 30-second elevator pitch as I can give for a company that has hundreds of products under its purview. But RealPage is a multifamily software as a service platform. We service really every facet of multifamily from a software provision perspective, not necessarily involved in like the development or the management of the properties directly, but obviously through proxy of the software services we provide. We have our hands in a lot of the different cookie jars across the spectrum of multifamily. With regards to myself and the side of the company that I work on, my name is Carl Whitaker, Director of Research and Analysis, and I work most directly with our market analytics platform. The market analytics platform within RealPage is part of our data and analytics services. Really, the crux of what we provide is market intelligence for different industry trends, rent growth, occupancy, demand, supply, really anything along that side of the market intelligence and market research platform. But we also do leverage a lot of the data that comes out of our property management systems. We're also leveraging a lot of third-party economic data to talk about some of these economic trends as they influence our forecasts and future expectations. So I'll leave it at that, but I can go in more depth if needed. But I don't want to get too into the nitty-gritty up front.
Yeah, no, that's great. Thanks for that elevator description of a massive company. I would say when we look back 10 years, let's say 2010, 11, 12, it was pretty easy to buy multifamily properties because prices were so low, right? And you could make a lot of mistakes back then, right? And even 5, 6, 7 years ago, the market still allowed a lot of mistakes. Where we are today with record prices in multifamily, the data and the forecasting and having accurate data is absolutely crucial to make a decision whether one wants to buy a property and whether one can pay a price or should not pay a price. And obviously, if one already owns a property, then it's crucial to really maximize the revenue stream as well as ultimately the NOI. So I would say market insight today is more important than ever. So we are really excited to have you on so that you can give us a little bit of an insight from a research and market analysis perspective.
So, Carl, coming from, I'm on the operator side. We own a lot of properties, both in Texas and Georgia, and we're looking to kind of get into Florida. And what I'm seeing from the acquisition side is just insane valuations, but the brokers have in their back pocket, well, you've got these lease trade outs that are pretty strong. And in a lot of cases they are, right? I guess my question to you, and I know you don't have a crystal ball, but what are you guys seeing in the market in terms of rent growth? I mean, is that pretty much across the whole entire United States? And why do you think that was? I mean, I guess I know that's kind of a little bit of a loaded question, but I seeing that you're really kind of boots on the ground in terms of the analysis and the data, I'd love to hear your perspective on that.
Yeah, that's a great question. I think there's a few different ways we could break it out, but I'll just start with what was actually one of our key storylines for 2021 data. Whenever we look at the national perspective, to your question on, are we seeing, what are we seeing in all markets, Ben? The nation overall absorbed something like 675,000 units in 2021. And even though that sounds like a big number, when you look at it contextually, that was 60% greater than the previous annual peak dating back to the early 1990s. There may have been a point in the 1980s when just a ton of product was getting built that number would be higher than. But, if you go back 30 years, we saw peak demand in 2021, just absolutely incredible. And that was pretty much the true across every market. I think what you had is just kind of a perfect storm of a lot of influences. The pandemic obviously caused a lot of pent-up demand. There wasn't as much movement happening throughout most of 2020, and in some markets, even into early 2021. Summer 2021 rolls around. Some folks that maybe had signed lease renewals were starting to get back out into the market. I think you also had something that maybe gets discounted in the grand scheme of things, but you also had 2 years worth of college graduates releasing out into the market. And you typically see that in any sort of recessionary recovery period, where, you just have folks that decide to double up in households in an effort to save money, a lot of economic unknowns, maybe some younger adults moving back home with mom and dad, at least until they can feel better about their job prospects. So you kind of had that perfect storm of demand that just suddenly hit the market, or I say suddenly, it seemingly suddenly hit the market back in 2021 during the summer months. And that's driven, the brokers are actually looking at that from a very well-informed perspective. I mean, we're seeing incredible trade out today. New lease trade out in January for the US overall was something like 18%. Even renewals are looking at 10 to 11%. And I'll share some thoughts. I'm sure we'll get to it later on the catch-up game that's happening for renewal rents relative to new lease. But outside of just a handful of markets, I mean, you're pretty much seeing double-digit trade out across the board.
Do you think that some of it has to do, and I was actually talking to a broker about this yesterday, a lot of it might be, or at least his opinion of it was that, hey, single family homes are also hard to rent. They're extremely competitive. People can't afford the down payments or just don't want to buy a house. And that's leading also to just that apartment demand, because people are getting priced out on either buying a house or renting a house. And so obviously, they want to have their own place. They got to go to an apartment. And that's leading to some additional demand as well. Do you think that there's some validity in that statement?
I do. I think there's probably a little bit. I think something that maybe gets overstated at times, though, is that single family markets success comes at the expense of multifamily. And if you look at if you look at a chart of single family home demand plotted next to multifamily demand, those two actually move in conjunction. So I think it's just simply the rising tide of all demand right now is boosting all ships. And I think you just look at some of the challenges when it comes to finding a home, whether it be multifamily or single family today, are simply due to supply shortages that we had throughout the better part of the 2010s. I mean, I want to say that it wasn't until 2014 or 2015 that multifamily permitting levels had got back to their pre-Great Recession peak, and we're still a long way from the pre-Great Recession peak on the single family side. That's not to say we should be permitting whatever it was, 1.3 million homes that were being permitted at that time, but clearly you've had essentially a decade of a supply shortage, and now that's really starting to come to the forefront of the discussion. And I think we all see it.
And I would say, it's probably going to be even made worse just because of the material shortages and lumber prices that have been kind of all over the map, and including extremely high. So, I guess that's just going to lead into greater demand, I would say, for any kind of rental housing. It doesn't really matter if it's single family or apartment, but obviously, like you said, all ships rise with the tide, which is a good thing for apartment operators.
Absolutely.
So I guess the $1 million, maybe even $1 billion question, though, is that rent growth going to continue, and how can it? I mean, like, we already have an affordability problem in this country too, which, yes, we have a housing shortage, but what we're also seeing is that, ultimately wage growth isn't really keeping up with a lot of this stuff too. And people are just getting priced out, can people afford $20, rent pops when they're coming up on a renewal, or $20 more than they were paying at the last place just to get into a new place. I mean, what are you seeing from that perspective?
Yeah, there's really two components to that question. So the first part is, can rent growth continue? I think the answer is yes and no. Rent growth is probably going to continue in our eyes. Just it's going to be very hard to mirror what happened in 2021. And I think something else with 2021 to keep in mind is that you were essentially catching up with growth that would have happened in 2020. A lot of operators, I should say, weren't necessarily in a position to raise rents. Certainly nobody wanted to be the folks that were making headlines for raising renewals during a pandemic. So, some of those extraneous factors kept rent growth compressed. So 2021, a little bit of a game of catch up. I do think that you just have to look at it from a purely objective perspective and say that inflation is a component of that overall number. Now, whether it's 100% inflation driven or a tenth of percent inflation driven, the answer is likely somewhere in between. But I think those two factors indicate that you're not going to see 2021 levels of rent growth going forward. Now, the second part of that, on the affordability side, some of the data that RealPage tracks actually counters what you're hearing in some of the broader affordability narrative. And what I mean by that is, and I'd be happy to share after our discussion today, but RealPage, as part of our property management systems, we're actually able to track listed income levels on resident leases. And of course, the data gets anonymized. It gets rolled up to, say, a market level or even the national level. But we actually saw that the average income among new lease signees in 2021, whether that was somebody that was signing a lease for the first time or somebody that was moving out of their old unit and into a new unit at a different property, those new lease incomes were up almost 14%. New lease trade out was up about 16%. So those income levels are moving at about the same pace. I think the difference in affordability comparisons oftentimes comes down to, when tracked by the census, it's looking at the entire universe of rental housing. And our data is looking at professionally owned and operated investment grade multifamily properties. And that's more of the pool that we're all working in. That's the sandbox that we play in. All three of us on this call, for that matter of fact. And I think if you compare that apples to apples affordability story, it suggests that rent growth can continue at a faster rate than some of the 35 to 40% rent to income comparisons that you may see elsewhere.
Does RealPage break it down by class A, B, and C though? I mean, I guess, I'm curious if that 15% is more on the professional class A, the working professionals, the laptop, society that we find ourselves in, which I'm included in as well, right? People that, hey, we just went virtual during the pandemic versus, getting laid off. And so, I'm curious if that 15%, if you guys really break it down even more than that and determine, hey, this property is really kind of in a class C market or in a class C property, and they're only seeing wage growth by 5%, for example.
Yeah, that's a good distinction. And I'm glad you bring it up, because we do distinguish from A, B, and C, and we get a little bit more granular, but just for the sake of this conversation, what we've actually noticed, and it's somewhat counter to, I think, what a lot of people think, at least on the surface level, but what we've seen is that Class A apartments, the rent to income level that we track is usually in the upper teens. So even though those units are renting for more, those residents tend to make more. And you also have a lot of folks in that pool that would fit kind of your renter by choice lifestyle. Maybe some younger non-married adults who are a little bit further in their career. They still like to live downtown. Maybe they're living in a more expensive market. They could afford a home if they were, whether in that market or moving elsewhere in the country. But, clearly there's something about the lifestyle that they prefer renting versus owning. Class B rent to income, we see in the lower 20%. I don't have the exact number off the top of my head, but I want to say it's 21 or 22%. And that's going to be the vast majority of the classifications that we dole out. Class C, you do see that rent to income ratio start to creep up a little bit. But even in the properties that we would classify as C minus, very workforce housing, blue collar dominated areas, whether it be a submarket or a market, those rent to income ratios are generally below 27 to 28%. So affordability, even though it does creep up as you go down the product spectrum, it's really not an issue until we get into, some of your true workforce housing areas or some of your, very localized product, I would say.
Why do you think that is? I mean, I guess the message that the media likes to say is that, they pump that. And even I've kind of been brainwashed, apparently, right? And this is why we love having you on, right? We can kind of dive into what is the real world data saying. Why do you think that they're trying to pump that out? And what's the story behind that, right? Because I think that they've got, and then it almost demonizes the landlords because, we're jacking rent on, this person that just can't afford it, and
right.
we're the greedy capitalists in society, right? When the data is really not even telling us that. Do you, any kind of thoughts on that?
Yeah, it's really tough because I don't think there's any. I genuinely don't think that there's a nefarious intent upon or in reporting that data. And I'm going to reference census data here. This isn't to single them out. It's just that the census is the most readily available data set that we have on this. The census data is, again, looking at the universe of all rental housing. So it's looking at, again, the sandbox that we're working in, but it also looks at mom and pop rentals. It looks at duplex rentals, single family rentals, and it compares income levels of those rental properties or those household incomes to market rate multifamily rents. And that's because the market rate multifamily rents are what's most readily available. And that's data coming from, companies like us or some of our competitors that also track the market. So you're kind of getting an apples to oranges comparison there, where your single family renter is probably not going to be the person that would choose to rent a investment grade multifamily property, but those income levels get compared to those market rents. So I always use the example, it's not necessarily fully an apples to oranges comparison. It's almost like a tangerine to oranges comparison. It's related enough, but it's not the perfect corollary to one another.
Gotcha.
So this is really very eye-opening, right? What you just said. Obviously, the expectation certainly is in the A class that it's in the teens, right? B class in the low 20s. That's still pretty low. But the C class side is only the most eye-opening, what you just mentioned. So my question there is, what about delinquencies? Because with these type of rent-to-income ratios, you would think across the board the delinquency should be pretty low, even when you go down to the C class level. Yet we sometimes see properties that are really struggling in professionally managed properties. So are you tracking this also by class, and what do you see there?
Yeah, this is something that we started tracking. We've had data that goes back a little bit further historically, but we started tracking it in earnest in March 2020. We started working with a consortium of providers who were providing data to the National Multifamily Housing Council, because this was also a policy concern at the time. And I mean, there was a lot of buzz around this topic. So to answer the question, what we've done is we do have data that shows missed payments dating back to, I believe, 2019, if my memory serves me correct. And surprisingly, and I think candidly speaking, we were all a little surprised by this, but overall payments or delinquencies, I should say, didn't come into the picture as much as we had initially feared. We thought that delinquencies maybe would creep up into a concerning level, but even pre-pandemic, it was almost impossible to collect 100% of rents on 100% of properties. And I want to say that typical, quote unquote, typical rent collections were something like 97% across all product across the nation. And even during the depths of the 2020 downturn, those differences were only off by 200 to 300 basis points. Put it another way, you had about 94, 95% of market rate renters were paying rent on time and in full. And part of that also points to the work that folks such as Ben are doing, that was operators that were taking a very caring, understanding approach to the challenges and the needs of their residents, and were willing to work with those residents so that they weren't setting their properties up for failure, but also weren't putting residents in a position where they were going to be, behind the eight ball whenever things did improve. So a lot of that points to a lot of really wise operations from the property managers themselves. The one exception I would say, and Anton, you actually did touch on this in a pretty concise way, we did start to see delinquencies creep up a little bit more in certain product types, particularly Class C assets. And there are a handful of markets that actually did have a little bit more of a delinquency issue. A lot of those that we saw were areas that had more restrictive legislation, a lot of the West Coast markets, a lot of eviction moratoriums that in turn ended up leading to some more delinquencies than what we saw in, let's say, a lot of Sunbelt markets or Florida or Texas. And then you had a few isolated markets like Las Vegas that just inherently tend to have a more transient renter population. Delinquencies were a little bit higher there, but they were also higher on the spectrum whenever you look at that market compared to the nation heading into the pandemic. So I don't know that anything necessarily changed, but you did see, let's call it 200 to maybe 300 basis points worth of, or 2 to 3% of renters that were paying pre-pandemic weren't paying post-pandemic.
And I think that, just coming from, I'm looking at this strictly from an operator's perspective. On some of our properties, that was probably the case, and some of them it was going to be higher than that. I think what I saw was just kind of a progression, and as soon as kind of policy was enacted to kind of the eviction moratorium, because remember, the eviction moratorium didn't happen until I think it was maybe September of 2020.
It was late on, yeah.
Yeah, so people were still trying to make payments because they didn't really know what was going to happen, right? And then the eviction moratorium slammed in, and then they started talking about rolling out rental relief programs. And then I thought, what I saw is I started seeing creep up even more, right? So people kind of got, okay, hey, they had the landlords no longer have, a process to evict me. Therefore, my motivation to pay them, at least pay them timely, is going, down, right? So it was kind of interesting because we all kind of got through the summer of 2020. We're like, okay, it actually wasn't that bad. Valuations didn't go down. Stuff started kind of popping in July and August in terms of, new transactions and new sales. And I thought we might have, seen the worst of it. And then Trump signs the eviction moratorium, and that's when I started seeing things kind of going kind of off a cliff, to be honest with you. So, but it's interesting to kind of see it from a national perspective that it really, I guess on average wasn't too bad. But yeah, I mean, I've seen it certainly double digits. And that's coming from a guy that's operated properties, and then a person that we underwrite probably 50 or 60 deals a week. That delinquency is still, at least on the workforce housing side, is these people are still carrying massive balances. And so it's just kind of interesting to kind of see that the different data sets in terms of this. But, it's one of those things that I think for the next 6 to 12 months, we're still going to have to work through, because the backlog in the eviction court is massive. Yeah. I mean, some places, we have properties in Atlanta that are just now opening. And guess what they're telling us? We're starting in March of 2020 and we're working our way through it. So you've got 2 years and massive amounts of people that are on this eviction hearing, docket. And, so I think that, let's be honest, eviction courts aren't very efficient anyway. I think you're bare minimum, probably 12 months to work our way through that process. And then what does that look like? Right. And I guess, the question of all that statement is, you've got these renters that will be evicted. It won't be a tsunami like everybody in the media made it out to be, but it's going to be a fair amount of people. What happens to rents then? I guess would be the question, right? Does that depress rents in some ways, or does that increase them? I don't know. I guess that's a question for you, Carl. I mean, do you think that? I mean, what would you bet on? With the evictions kind of happening over the next 6 to 12 months.
Yeah, that's definitely where that crystal ball would come in handy, because that's a tough question. And
I'm trying to get some perspective here so I can be a better operator. But no, just best guess. What do you think? You're looking at the data. What would be your play?
Yeah, and I'll just, I mean, first I'll say thank you for sharing that too, because that's really interesting to hear. Whenever we talk to folks who are, operating day in and day out, it's actually good to hear that. That way we can help calibrate our expectations. A lot of times we're looking at national or market level averages, and averages can sometimes be a little bit misleading and can, certainly not paint the full picture of what's going on. So I actually appreciate y'all sharing that there. As far as what happens, and I like that you said that there's really no expectation of an eviction tsunami, because I do think that some of those fears were initially overblown, maybe warranted, but certainly I think ended up becoming overblown.
Yeah.
Knowing now what we know versus what we didn't know 2 years ago. My expectation would be that eviction moratoriums certainly would be some sort of a headwind to rent growth in the future. I certainly don't think that it would result in rent cuts per se, but I do think that that would put some downward pressure on both new lease rent growth and on renewal rent growth. So I think the expectation, and maybe it's a little bit more property specific, or maybe it's more, neighborhood specific or submarket specific, but I do think that could result in some headwinds to future rent growth. The degree to which, not really sure. Anything that I would say would probably be conjecture, but I certainly do think that that would result in some downward pressure at the very least.
And I think some of it really depends. It's kind of a little bit of a loaded question too, but I think at the end of the day, right, you're also looking at the market, like you said, because maybe you've got a massive amount of product coming online, or maybe you don't have any product coming online, right? If it's a constricted market in terms of supply anyway, that actually might lead to rent growth, I would say, right? Maybe potentially, who knows, right? Now you've got a bigger renter pool, so yeah, you're 100 people say no to that $2,000 rent. Somebody might say yes, right? Because you have more people that are going to come in the door that could potentially be, a part of your renter pool. I don't know. I guess time will tell, right? But yeah. I think it was interesting to kind of see that tsunami did not materialize, and I think everybody that's kind of in that workforce housing, space is kind of seeing, what is this going to do to my property? What is it going to do to property valuations? What is it going to do to rents? And I guess time will tell. But yeah, I would just, people that are listening, I'm thinking it's at least 12 months out, and the eviction courts are just slammed trying to make their way through it. And, and they're also forcing, in a lot of ways, landlords to cut deals with people too. Just to, I know Atlanta specifically is kind of more pro tenant than, say, a Texas. And they're dragging the landlords and the property management companies into the court, and they're trying to cut deals. So a lot of these people, so they're trying to kind of head off a lot of these evictions too, as part of it. Like, hey, we'll give you 5,000, take the 5,000, just wipe the balance clean, is essentially what they're telling us. So a different approach than what I've seen in other states, but I guess that's their way of, hey, we don't want to be known as the county that has evicted half the renter pool. And where are these people going to go? They might end up on the streets, so they might end up committing crime. And so they're just taking a different approach. So, I think that's the one thing that's been interesting as an operator to see coming out of the pandemic, what delinquency and what these eviction moratoriums, because nobody's ever seen stuff like this before.
Yeah.
And so
totally right.
It's and then you add all of these different components that nobody, it's funny. It's like, you're talking to people like Anton or brokers that have been in the market for a while. They've never seen a market like this. And so nobody really knows what's going to happen. And then you slam inflation on top of it, of all things. And now you've got all this stuff that's going up in price. And so the landlords are kind of getting pinched on the material side, getting pinched on taxes, getting pinched on insurance, and they're almost forced to increase rents. That's the other thing that people aren't talking about too, is, hey, all this other stuff's going up too. And by default, this is a for-profit business. Rent's got to go up too. So taking a supply and demand, taking that completely out. Right. They're just forced to raise rents just to break even or even make a little bit of a profit.
Right.
Yeah. So Ben brings up a good point here. And right, we talk to so many operators every single day. One of the messages that we hear over and over and over is, yes, we were able to raise rents 10%, 15%, 20%, but the result on the NOI is not really there, right? Because Wages have gone up.
Yep.
Taxes have gone up, obviously, in markets like Texas and some others where the reassessments have come in really aggressively. Insurance has gone up. So operators really do not really see the benefit of all that rent growth flowing into the NOI. So have you, based on the research and all the tracking that you do, what have you seen there, Carl?
Yeah, both of those are great points. And I think you're exactly right. There's been, this never before seen rent growth, but there's also been, I wouldn't go as far to say never before seen expense pressure, but, as you point out there, the, rising labor costs, construction costs, insurance. I think insurance is kind of this one part of the one piece of the pie that doesn't get talked about enough. And I think that's something that, we've all seen insurance premiums go up. And, I happen to live in Texas and live in Dallas here. And, we saw insurance premiums go up a lot as a result of that February storm. So, there's certainly markets, South Florida, with, concerns there of, increased flooding and hurricane risk, and those premiums have gone up. But anyway, I digress. So one of the things that RealPage has actually seen, and I hope this doesn't come off as too salesy, because I'm certainly not a salesperson. I'm definitely living in the analytics world. But something that we've seen through tracking the data is that a lot of operators have got to the point where they're looking at technology solutions that help alleviate some of these cost pressures. And what I mean by that is, one of the more stark or striking data points that we tracked that kind of surprised us initially back in 2020 was that payroll expenses for apartment properties were actually a little bit choppy. First they went up, and then they went down, then they went up. But what we actually saw was that with more companies using virtual leasing, for instance, that actually took more folks off site and therefore alleviated some of those cost pressures. We've also seen one of the product families that we have at RealPage is dedicated to environmental solutions. So what we've seen is some of these technology solutions that, of course, have an associated cost, but a technology solution that's able to manage your water usage at properties and see if there's anything out of whack there. Maybe your water bill is actually a few $1,000s a month cheaper, and you're actually able to eat away at some of those expenses because you're just smarter with your resource management. So we have seen expenses go up across the board, but it's really fascinating to see how some of these technology solutions are targeted at offsetting some of that pressure. And maybe it doesn't offset all the pressure, but it's certainly a creative way to attack a growing problem and something that is, an emerging or an evolving industry trend that is, again, expenses rising and the cost of an inflationary environment.
Yeah, and I think you bring up a great point. I think we're kind of in a situation where it forces people to get creative from an operation standpoint, and
problems require creative solutions.
That's true, right? Hey, all right, so we've got to see where we can kind of cut costs without cutting quality of service, right? Because a lot of people will kind of look at it short-sightedly. Oh, payroll's high, so let's just have 2 leasing people versus 3. Right. And then the quality of service goes down. Right. And then it's just a death spiral from there. People just don't get the long-term repercussions of sometimes their decisions. Right. But, I love that you're bringing that up, because for the operators that are listening to this podcast, right, you need to be looking creatively, and technology is in a lot of ways a great way to streamline and make more productive the operational component of multifamily. I think in a lot of ways people just, they haven't needed to do it, like Anton alluded to earlier in the show, right? Back in the day, you could just stumble into these things and you're going to make money. Yeah. Now things are so tight that you have to look at every line item and is there anywhere that I can squeeze that I can make a little bit more juice out of this, or make it a little bit more efficient, therefore more profitable. So I love the utilities. You really have to kind of look into that, because, especially on the workforce housing stuff, the older stuff, there's a lot of leakage there, no pun intended. And then, I think one of the other trends that we're starting to see, again, I'm not sure how much it's going to happen in the workforce housing market, but, kind of more the B and the A space is that virtual leasing, and allowing and forcing people to do more things online. If you can go through from a virtual tour, if you can find the property online, then you can go to the website, you can take a virtual tour, then you can go straight into the lease process. You've almost, you no longer really need many leasing people. And I hate to say that for the leasing people that are listening to the show, but, at the end of the day, the leasing person is just there just to answer the random question that somebody might have versus selling them on the property, because technology can pretty much do the whole entire job. So
yeah, it's really fascinating.
We're also seeing kiosks, in properties where, people can kind of do a lot of this stuff, just, coming in, boom, boom, boom. All right, you fill out this and it's done. So again, and just like what you see in an airport check-in process where they've gotten rid of the ticket agent, right? Same process can happen here. And so I think this decade is going to be the decade of, hey, you have to be smart about how you manage your expenses, and the adoption of technology. I think it's just going to be more and more. Hopefully, and hopefully that's a good thing, right? That will not necessitate the forcing of the rents as high, because, hey, you're making it up on being more efficient too, right?
Yeah, absolutely. And two things there real quick on the the idea of needing fewer folks on site for maybe certain tasks. There's almost this Schumpeterian creative destruction of certain industry trends maybe seem like net negatives in the short term, but in the long term actually end up being net positives. It finds its ways of finding efficiencies that are market forces creating these efficiencies, and again ends up being a net positive in the long run. On top of that, you also see some of these industry trends are evolving with generational and demographic preferences too. I'm right at that cusp of being old enough to actually remember having a phone book and having to make a call for some of these things. But you go 10 years younger than me, and by the way, those are the folks coming in to rent their first property today. They want to do everything that they can online. The idea of calling somebody up is almost a paralyzing fear, because it's just catering to a different generation. And I'm not saying that's necessarily a bad thing. It's just, you see these generational trends shift, and somebody that's far more technologically savvy than even myself, who's maybe 10, 15 years older, those trends are evolving to meet the needs of that younger generation. So I think that's something that also needs to be taken into consideration. I don't know how you measure it per se, but it's a fun thought experiment, if nothing else.
Again, yes, you just have to play to, what are the renters looking for in the market, right? And I think you bring up a good point that over the next 10 years, the renter pool is going to be significantly different, and they're going to have different wants and needs and different ways of buying products and services. And the people that can kind of get ahead of that through technology and marketing, processes are going to probably be the ones that are going to be the most successful. So, I 100% agree. So I'm going to throw a curveball at you.
Okay.
All right. So and we had a conference recently, and I threw the same question at Anton, or I think somebody from the audience might have, is, where do you see interest rates going, right? And what do you see that doing as far as valuations on these properties, right? And I know, again, you might have to get your crystal ball out on this one, but obviously you're a smart guy and you look at the data day to day. And I'm just curious what you guys and your team from RealPage is kind of, where do you think the market's going with that?
Yeah, this is definitely a curveball question. I've been getting 90-mile-an-hour fastballs down the plate here, and now we've got an off speed. But I appreciate the heads up that it was coming. Honestly, though, jokes aside, that is a really, really good question, and something that, of course, there's a ton of unknown on the horizon. Interestingly enough, I saw a chart this morning, and don't hold me to like the exact specifics of it, because I may get some of this a little bit wrong, but I think it was a chart showing the likelihood of a 50 basis points increase from the Fed over the next, I think it was 8 months. I think it was basically through the end of the year. And up until the news yesterday, that likelihood was like 87% that at least a 50 basis point increase would be coming. Today, I think that's down to like 15%. So I think that a lot of the geopolitics and just the climate that we're in right now added a lot of uncertainty. And I think, now keep in mind, this isn't coming directly from the Fed. This is just sentiment on what the Fed might do. But either way, within the past even 24 hours, we've had a lot of additional unknown added to an already unknown circumstance. So I'm kind of beating around the question up to this point, but what I would say,
I think that's great though, right? You bring up a good point, right? That, I think up until literally probably yesterday, it was almost a foregone conclusion that they were going to raise rates, at least something, right? And now it's like, okay, hey, things have completely flipped on its head. And now who knows, right? And I think the other thing that people aren't talking about too is if they raise rates too quickly or too much, that could have a real adverse effect on the market as a whole. And brokers don't like to talk about it, but interest rates, yes, they don't necessarily, it's not a 1-for-1 correlation in terms of cap rates. I get that, right? But people need to realize that, hey, if your debt goes up in terms of how expensive it is, that's going to put some downward pressure on the returns that you can get on these deals. And I think just it might, if nothing else, give people a pause on some of the valuations that we're seeing. And just to kind of give some people some perspective, because again, we look at a lot of deals, the brokers that are talking to us now are saying, wait until you see the valuations coming out in the next couple of months, because they can, in a lot of ways, they can kind of forecast out because they have this BOV process and they kind of know where things are going to be over the next 2 or 3 months. And valuations, at least as far as they go right now, are still going up tremendously, like 10, 15, 20% in some cases. So, that's why I'm always curious to, people that are in the know, hey, what do you think about the interest rate environment? And what is that going to do? So, but that you brought up a great point. Who knows what this whole thing in Ukraine and Russia, and I mean, that just threw a monkey wrench in the whole entire thing.
Yeah.
So
yeah, that definitely added some uncertainty. And one thing I will add is, we were at NMHC, I guess it was, today's late February. So about a month ago, we were at NMHC in the annual strategies conference. And one of the panels was talking about the markets and, what we're seeing today. I can't remember which panelist it was, but one of them brought up a great point that, valuations today, if you look at property, if you look at loss to lease on property rent rolls, for instance, they're in many markets, not every market, but many markets. And I'll pick on Florida because you were mentioning Florida earlier. Florida is a great example of where there's still quite a bit of runway for rent growth on renewals. If you look at that loss to lease, because somebody that goes and shops at a new property might get tagged with a 20% increase on those rents staying in place. Maybe they get an 11% increase, but you also have to remember that vacancies are an all-time low right now. The data that we're tracking shows that vacancy is at 2.6 across the country. I mean, that's just like almost unthinkable. You've got something like 500,000 vacant units for a country that has 335 million people. And obviously not all those people are renters, but it's just, no matter how you look at that occupancy number, it's just truly staggering. And the reason I bring that up is I think that in underwriting some of these valuations and future expectations, I think some folks are underwriting with the expectation that late 2022 and early 2023 is going to continue to see pretty solid revenue growth from rent rolls, because you just have the simple math of a difference between new leases and renewals. Now, that's not a recommendation to take that into consideration, because that obviously adds a lot of risk. I'm by no means saying that that's how I would approach it, but at the same time, I don't think that it's necessarily one of these things that is as risky as it was historically, because you can track that difference between your in-place rents and those new lease rents. So that's something else that maybe is factoring into some decision making today. But man, like you said, just the transaction market right now is, I mean, I know we've said it's incredible for so many metrics, but maybe that's the most staggering.
And I mean, that's an interesting point, right? And then the brokers don't look at that level of detail.
Yeah, yeah.
They're all cost per pound guys and gals. But that's an interesting thing to kind of take into consideration too. Is there's more runway, I think, just organically. And so you just have to, as operators, you have to know that information and know where the markets are. And I would agree that Florida is almost it's an anomaly on itself in terms of the rent growth that we're seeing in some of those, in Tampa and Orlando. I mean, just tremendous $300, $400, $500 rent increases, and it's being absorbed. I mean, vacancy is not that high there either. So, people just need to take that into consideration. Obviously the brokers see that too. So, No.
So naturally, when it comes, and right, Ben mentioned we had that discussion at the conference that Ben and his team hosted in Houston a couple of weeks ago. When it comes to the cap rates and interest rates, it's always a discussion that is very hard to have, and appreciate, Carl, right, that you cannot answer there. I think it's still important to look back to 2008, 9, and 10, right, where obviously if the government put a lot of money into play to get the market moving, yet the interest rates came down, but cap rates still went up, right? And I think ultimately it's really the market sentiment and how many players are in the market that are buying properties. And once that side, I would say we clearly hear from you that demand for rental property solely is there, and it appears to continue in most markets, at least throughout this year, possibly next year. What we just do not know is whether the buyer pool will still be there at some point, right? And that is with the geopolitical elements, with the impact it has on financial assets, right? And real estate all has an impact, and whether it's institutional or buyers, they may shift their attention from one asset class to the next. So the reality is we do not know, but it's always we always need to estimate, right, where we are going, and that's the tough part, right? One also looking kind of forward with that crystal ball. I would say everyone agrees Sunbelt markets continue to be in demand, right? And they have been in demand now forever. Now, my question is, we certainly have seen that rush into the suburbs, right? And sometimes even into the more rural and secondary, tertiary markets. Where do you see that is going to happen, even in the Sunbelt markets that still continue to be in high demand? Do you see a move back more into the urban cores in places like Dallas, Fort Worth, like Orlando, Tampa, or do you see that the suburban areas still continue to benefit, or even the secondary markets in these places?
Yeah, the secondary markets. Don't let me forget. I actually want to come back to y'all on that because I have a question for y'all on secondary, tertiary markets. As far as the urban suburban dichotomy, 2020 showed that what happened in the urban cores actually came at the benefit of suburban areas. People moved out of urban cores into suburban pockets. You know, there's no need to, or at the time there was no need to pay a higher rent whenever you knew you weren't going into the office, and you know the things that made living there more expensive to begin with, access to nightlife, you know, all those quality of life components just simply weren't there. So people moved to the suburbs. Especially now in the Sunbelt markets, you're seeing those quality of life things come back to what it looked like maybe pre-COVID. Concerts are happening downtown. People are hanging out downtown, sporting events, et cetera, et cetera. But what's interesting is we've seen that actually in Sunbelt markets not come at the expense of the Sunbelt or the suburbs. So initially you had a boost in suburban performance. Urban performance was depressed. Now you're seeing urban performance start to match what's happening in the suburbs, but the suburbs are just kind of tapering off rather than, you know, falling down. It's really fascinating. And I think that points to, again, just the fact that you have this huge wave of pent-up demand that's releasing, and it wasn't like it was being borrowed from one bucket of demand and allocated to another. It's really just you had this bucket of demand that was overflowing, and now the other one's catching the overflow. I hope that's not too goofy of an example.
Well, you have so many people moving to the Sunbelt, right? That's the bottom line.
Exactly.
You know, so it's just keeping up with it.
Exactly.
So with that, the question is, are the suburban properties, let's say in the Northeast, are those the ones that are suffering the most, right? Because when you look at New York City, obviously rents are already above pre-pandemic level. People are moving back to urban cores. People at the same time move to the Sunbelt market. So do you see pressure on these suburban markets in the Northeast, and obviously to the benefit of the suburban markets in the Sun Belt.
I think we're seeing some of that. It's not quite as drastic as what we had initially thought it might be. I think the initial fear was that in San Francisco, LA, New York, et cetera, Chicago, maybe even, you had a mass exodus of people and it would take 5 years for LA to get back to pre-COVID rents. We're not necessarily seeing that. Or I think, Anton, you mentioned New York. New York's probably a better example in this regard. A mass exodus of people. We're seeing that suburban, let's call it suburban Northeast, suburban Mid-Atlantic, it's still lagging overall US pace of improvement, but things don't look as bad as what I think a lot of people, and candidly speaking, even ourselves, would have thought maybe even as late as fall of last year. You are starting to see some improvement. I'll use Chicago as an example. Chicago, fourth quarter almost always has a pretty big occupancy contraction. Nobody wants to move when it's 0 degrees outside. And, of course, the holidays. And it's a super seasonal market. People leave Chicago, they go to Naples for 6 months, and then they move back. You tend to see those seasonal swings. But this past year, Chicago occupancy didn't change in fourth quarter. And that's the first time we've ever seen that. So I don't think you're necessarily seeing what's happening in the Sun Belt is coming at the expense of some of these non-Sun Belt markets to the degree that we had initially thought that it might. And I think it kind of serves as a corollary to that urban suburban example of where you've got some rebalancing now, but it's not necessarily totally at the expense of option A or option B. It's more of an either or than make sure I'm saying that right. It's more of an either. Both of these things can be true rather than an and or. There we go. That's what I'm after.
All right. So I'm going to throw one last question at you. And this has been very insightful, Carl. We really, really appreciate you being on the show. So I'm going to shamelessly ask you a question because I'm more interested in it. All right.
Yeah,
so
of course.
3 markets that you like the best in the Sun Belt. And this is obviously based on data. Doesn't have to say, okay, I love Dallas because I live in Dallas.
Right.
This is all based on kind of the data that you're seeing, whether it be the rent growth, population growth, vacancy, loss to lead, whatever it might be, right? Just taking that analytical approach to it. Which ones are you choosing?
How about I give you one big market, one middle market, and then one small market in the Sun Belt? Okay. As far as big market, I think the market that's caught my attention the most is probably Raleigh-Durham. I really like the economic makeup there. You've got a really stable, or I should say a more stable base of renters because you have so many universities and research institutions. And 2020 was obviously an anomaly, but typically tends to be more of a recession-resistant base of renters. Of course, the headwind in Raleigh is going to always be construction and supply, but you've got one of the fastest growth metros in the country from a percent growth perspective. Raleigh is also kind of in that tranche of market that you've got a lot of people focused on Nashville right now. You've got a lot of people focused on Charlotte. To me, Raleigh kind of seems like that sixth man on an NBA roster that is poised to become an all-star further down the line. Yep. So I'm looking at Raleigh.
Well, as operators, you want to get in when it's when people don't really know about it too, right? Where it's not uber competitive like in Nashville or
exactly.
Charlotte,
exactly.
So I like that recommendation. Okay.
So that's why I say Raleigh-Durham on that one. And I should mention that there's a lot of other Sunbelt markets that I like, but Raleigh strikes me as particularly interesting from that perspective. From a mid-sized market perspective, and I guess it depends on how we define mid-sized to that matter, I'd probably have to go with, well, let me look at a small market. I'll do a small market before I get to mid-sized market. A small market, and we're talking really small here now in the Sun Belt, but one that struck me as potentially interesting is Asheville, North Carolina. And the reason I say that is Asheville is very small. It's like 30,000 existing units. So obviously there's risk when you get into a market that small, but our data shows that the average renter income there is about what you see in Seattle. That tends to surprise people because it's a pretty rural market, but I think you have a lot of retirees there. Obviously a lot of the retirees are going to be home buyers, but I do think you get some of that seasonal demand and if there is a headwind in Asheville, I think that you don't have a lot of high paying local jobs. It's still kind of a tourism driven economy. So maybe that creates a little bit of risk, but I like the Class B space there in particular, because you do have a little bit of a buffer in terms of your A and your C product performance. And then let's see, maybe for a mid-sized, I'm curious to see what some of the smaller Florida markets do. If you look at like a Cape Coral or a Sarasota, performance has been really good, but it's obviously going to have to come down from where it's at right now. But just what does that landing back to normal look like? I mean, our team forecasts each quarter, and I think one part of the world that we've undersold the strength of demand in is Sarasota, Cape Coral. Naples will be a little bit smaller, but that could be worth a look. It's
expensive.
It is expensive.
Definitely going up in Sarasota. Trust me. Yeah, we look down there, and it's a great market, but you're going to pay for that. And so, but it sounds like North Carolina might be something that people that are listening, you should take a peek at.
I think so.
I agree. I would agree with all of those.
The cat is out of the bag now. All
right. He said South Carolina, folks, not North Carolina.
Yeah, South Carolina. West Carolina.
Yeah, West Carolina. Very good. So really appreciate it, Carl, you coming on. That was very insightful. How can our listeners reach you?
Yeah, so there's a few different ways. Easiest way is www.realpage.com for company-wide information. On there's a link to our analytics website that would give you some insight into the types of trends we're tracking and what we're keeping an eye on. We also do produce a whole litany of webcasts. Those are available at realpage.com/webcasts. Some of those are market specific. Some of those are, here's new solutions that are coming out into the marketplace. And then just personally, if you need to reach out to me, Carl.Whitaker, that's WHITAKER @realpage.com. And I try to stay fairly active on LinkedIn, so would love to connect with anyone there. We try to post little fun tidbits or little insights into the market. So a few different options there, but happy to make myself available for any questions.
Yeah, okay, very good. Appreciate that. By the way, on LinkedIn, you just published some information about loss to lease, right? We touched up earlier, so that's a good item for everyone who is listening to look at. You break it down by market, right? So that's really very insightful there. Also, you and I will be on the panel at the Critical Multifamily Conference. So anyone who is it's in San Antonio in early May. So hopefully some of our listeners will join us there. So thanks again, Carl, for coming on. It was really great to have you, and looking forward to more insights from you in the future.
Thanks, Carl. Appreciate it. Really insightful stuff. Great to hear from you. And then I'll actually be at that conference too. So we'll meet you face to face here soon.
Yep.
All right.
Perfect.
Thanks, buddy.
Thanks, Sean.
Yeah. Bye-bye.